Good evening, everybody, and a very warm welcome to this edition of a Quarterly Connect webinar. Thank you, as always, for taking the time to attend this evening. We thank all our investors for trusting us to manage your wealth and all our distribution partners for the support extended to us over the past several years. Our overall firm-wide AUM is now slightly less than USD $10 billion or 83,000 crores, and a domestic India AUM across a PMS, AIF, and mutual fund schemes is now close to 25,000 crores. A big thank you for your continued support. This evening, we are joined by our founder Prashant Khemka, along with Parag Jariwala, Rohit Chordia, and Anand Bhavnani, senior members of our investment team. Prashant and Parag will provide a performance and portfolio update across our various PMS and AI fund vehicles. Prashant will also touch upon our global emerging market strategy. Post this, Rohit will do a deep dive on the quick commerce sector, the opportunities and challenges therein, given that this is an area which is attracting a lot of investor interest. After Rohit's session, we will have a Q&A with Prashant, Parag, Rohit, and Anand. Request you to kindly post your questions in the chat box. Prashant, over to you.
Thank you, Vivek, and thank you all for joining us today uh, for a discussion on the various portfolios that we are going to talk about, and very interestingly, a topic of high interest at this time, which is quick commerce. As many of you know, Swiggy is about to come with an IPO, and Zomato has been doing very well and piqued interest of various investors in their business model. So, myself keenly waiting to hear from Rohit. As Vivek pointed out, we are just shy of 10 billion at this time in AUM. But what I want to highlight is more than half of this. So, from India, it is 30%. 70% is from outside. Overall, in aggregate, 34% comes from institutions like sovereigns and pension plans and whatnot. And more than half worldwide comes from family offices, high net worth individuals, and wealth managers. So, very important constituency globally for us in our investor base. Coming to, we'll cover the two major components of the domestic India outside of the mutual fund. So mutual fund itself is now 15,000 crores or close to 15,000 crores, not quite 15,000. And the remaining 9 odd thousand is between 9 to 10,000 is between PMS and AIF. So in PMS, and we'll talk more about it, September was a good month. That's why we are just pointing it out there that it turned around the overall quarter performance to a positive 89 basis points for the third quarter, which wasn't enough to turn around year-to-date performance, but the trend of September is continuing thus far in October. And given what trends are underway right now, we are quite excited about what the coming times might hold. And we'll talk a lot more about that. Since inception, 131 basis points of alpha having delivered, and these are all net of fees, as is mentioned here. And I highlight that because what I'm told is there's mixed practice in the market, particularly when it comes to AIF, where performance numbers are often shown on a gross basis, gross of tax, which is quite fair, to be honest, because the benchmark doesn't pay tax. And investors can't invest in a benchmark. Yeah, even when you invest in an ETF or passive, you have to ultimately pay taxes. So comparing it against a benchmark which doesn't pay taxes does not make sense. But you have to just be careful when you're evaluating different managers whether they are adjusting for taxes, which is the right thing to do, but others who might not be adjusting for taxes, like when we see our AIF performance, those would not be adjusted for taxes. So those would be net of taxes. So 20% compared to 18, and hence over this six from 2018 till 2024, we've now covered 6 years, which is not quite a full market cycle, but we're getting closer to it now. And the team has delivered alpha during this time period. Certainly, the first 3 years were much stronger compared to the subsequent 2 years, 22 and 23. We've discussed at length the reasons for that, and we'll recap later on as well. Since inception, most of the alpha, almost all of the alpha has come from stock selection when looking at market cap attribution. About 58% of the portfolio on average, the team has invested in large cap, about 40+% in mid and small cap. That's also important when you compare portfolio returns across board. You can't just compare a flexi cap kind of portfolio, which this is, to someone who's just managing a small cap portfolio. Yeah. So if you were to compare them team skill, one should compare small cap portfolios against small cap and all cap flexi cap portfolio against flexi cap, multi cap against multi cap. So many portfolios out there which are 80% mid cap also get categorized in all cap. But comparing an 80% small cap versus a 40% small and mid cap would give apples to apples comparison over smaller time periods like 2 years, 3 years, 4 years. Yeah, if you were to do that, then you have to do it over a full market cycle, which, as I said, even 6 years isn't a full market cycle, and you'll see later on why I say that. Sector attribution as well, 55% of 62% has come from stock selection, positive across almost every sector, just as you saw on the previous slide. Alpha is positive across all market cap segment. Again, sectorally also, we are very well distributed across various sectors, with some exceptions like energy. We hardly have had historically much allocation, and utilities, we've hardly had much allocation. That has cost us because utilities has been one of the top performing uh, sectors over the last few years. Not as much energy, but utilities underweight has cost us. Amongst the top 10 contributors and detractors, as you can see, some of the names I would highlight later, worth highlighting here as well. InfoEdge, one of the new age companies, which has a big stake in Zomato. It is the largest shareholder. Its larger shareholding in Zomato for InfoEdge compared to the founders. Yeah. InfoEdge was like a venture capital stage investor in Zomato. And one of the key reasons we've owned InfoEdge since pretty much start of WhiteOak is because our view that the value of some of these investments like Zomato and Policy Bazaar, the market was underappreciating at the time because those names weren't listed. And since obviously got listed, and the market started recognizing the value of those investments in InfoEd's portfolio. Zomato itself this year has been amongst the top contributor for us, and so has InfoEdge. Obviously, Zomato being up 120% has also contributed to performance of InfoEdge, as about 25% of the value of InfoEdge now comes from Zomato. The laggards this year, as you can see, are not down, but they're just not done as well as the benchmark or the market, because the market's up 20+%. So Nestle, uh, being just flat to slightly positive, has been the biggest detractor. This is contributor for the quarter. Again, Zomato is at the top. Trent as well has done well. Trent year to date is also the second largest contributor. CG Power has done very well in October as well. It's doing extremely well. Yeah. If you look at some of the names here would be common. Yeah. This is the portfolio composition as of now. There's only one name in utilities as of now. Otherwise, considerable underweight in utilities and energy, whereas usual what you see continue to be very well allocated to the sectors that have tended to be always well allocated in the portfolio, that is healthcare, industrials, financials, technology, and consumer discretionary. In terms of small cap and mid cap, we have about 41% both put together, 58% in large cap. We've started breaking out this exposure here, what we consider tend to have somewhat weaker governance segments. So conglomerates, because of the opacity of the businesses and the accounting, as well as the state-owned enterprises and some others put together is about 21% of the portfolio compared to 34% of the benchmark. Now, the same, I'm going to go over quickly the AIF and history, including WIFE1, which we've redeemed since inception, 18.4 compared to 16.5, 189 basis points. These are again important to highlight. These are net total return, net of all fees and expenses. And here, the year-to-date number has already turned positive. AIF being closed-ended structure, the team does buy some of the less liquid, smaller caps in AIFs, and a couple of them have done very well this year, which has contributed to extra alpha. Third quarter was particularly strong, as you can see, 400 basis points, driven by September, which was 223 basis points of alpha. This is WIFE 2, just because WIFE 1 has been, the money has already been returned, which is included in here in the performance history. We are now just highlighting WIFE 2. As I was saying, performance is same year as we saw on the previous sheet. Overall, WIFE 2 continues to outperform. Market cap attribution, again, similar, all of the alphas coming from stock selection. Again, pretty much all directionally the same thing, so not going to belabor. Again, you see the same, some of the same names, because most of the names the team would tend to own would be similar across the portfolio, though there would be some differences. Like, as I was saying, Shelly is a very small cap name. Even now, one could argue at the start of the year was a micro cap, very illiquid micro cap, but appropriate enough for a closed-ended CAC 3 fund. That one's up 200% year to date and has contributed very handsomely to the performance of the AIF. Similarly, Manorma, again, a micro cap at the beginning of the year, and even now, one of the smallest of the small caps, has done very well this year and contributed. So some of these names have done extraordinarily well, as many of the micro caps in the market have done, and we do own some of those in the AIF. Zomato again at the top of the list here, and this is just for the quarter. Again, similar names, so not going to elaborate. Sequent Scientific, again a small micro cap name, and Edelweiss Financial Services, which we bought earlier in the quarter, have done well over here. Portfolio composition is pretty similar, except for the fact you'll notice that the small cap is a lot higher in AIF. Yeah, so mid cap is 13, small cap is 43, combined together is 56. Whereas in the Pioneer, the mix was 15 and 25. So instead of 25 in small cap, the small cap weight in AIF is at 44%. And large caps are accordingly lower. One thing I want to highlight here, so in the past, also I've highlighted this, but particularly important, as many of you might have read the Roger Federer tweet where he said that he only won 54% of his shots over his career, which was quite surprising given his strong standing. One would have expected him to have won like 70-80% or thereabouts. The average in the market is 50-50. It's like a coin flip in the equity markets. On our team, since our inception, the team has made 176 distinct investments, of which they've got 101 right. That is 58% strike rate. 58% strike rate over such a large number of names, which is 176, is an extraordinary performance. Remember, it's very different to have 58% strike rate if 10 out of 18 stocks have outperformed. While the strike rate is, again, somewhere in the neighborhood of 58%, this can be very likely fluke. I mean, 1 in I don't know where to work out the odds, but heads or tails, if you do, anyways, 9 out of 18 would be right. To get 10 out of 18 is no big deal. Say the odds of getting 10 out of 18 right, even when there is no skill, just purely out of luck, would be, let's say, 1 in 2. So every time you have a set of 18 coin flips, half the time you might get 10 out of 18. But to get 101 heads out of 176 would not be 1 out of 2. I haven't done the math, but quite likely it'll be 1 out of 100 million or some such number. Yeah, just the way probabilities work. I hope you all are following me on this. So the skill that is you know reflected in this number is extraordinary level of skill of the team. Now, we've highlighted some stocks here. This is Nika, which has cost us minus 87 basis points. This is Car Trade, which has cost us minus 44 basis points. Is Zomato plus 62 and Info Edge plus 900 basis points since our inception. If you do the math, I think it would come to something like 831, if I'm not mistaken, and somewhere in that range. Yeah. So 831 basis points of alpha added in so-called new age business models. Reason I highlight that is these companies had a very tough year in calendar year 22, and our team got tremendous amount of pushback from everyone, including most investors, that what are you thinking investing in companies like Zomato at the valuations that existed then, which today look uh, very attractive if one can get those valuations. But at that time, people were citing a US professor who put out a price target of 34, a highly respected professor, not to take away from his reputation and his judgment, but there was a price target under some circumstances of 34 rupees, which is less than, as people or some media outlets said, Zomato was worth less than the price of a kg of tomato. It wasn't making any profits and whatnot. Today, the stock is worth 280 or thereabouts, and it has become market darling. Yeah. So very important, I think. And then there are numerous lessons in my career of this type when investors or competition also relishes such opportunities because they know what we own, and they'd like to highlight these things to investors as well. But investors, when they give money to managers to invest, that should be on sound basis after evaluating how the past performance has done, what is the philosophy, what is the process, what is risk management, and so on and so forth. But then you should let the manager do their job. If you start managing the portfolio for the manager, then it is a wasted effort really on part of everyone. The investors should then manage the portfolio themselves. Yes, managers would make some mistake because as Roger Federer has lost 46% of his points, and we have lost money in, as I was showing on this slide, 42% of our investments, yeah, we would lose money. But predominance of time, I mean, 58% is extraordinary, outlier, exceptional when measured over 176 data points. Yeah. On aggregate, we've done very well. And if you add these together, as I showed earlier, 831 basis points from these four, we are not going to get 100% of them right. Yeah. When we get them right, we are getting them right by higher magnitude. And overall, we are getting them right more often than we are getting wrong. So I do remember in 22, several clients left us simply because we had invested in a name like Zomato, where there was so much negative media, press, and Twitter, and all those posts that bothered them and swayed their view. So since our strategy inception, and this I must caveat includes time period like 2017, early part of 2017 when we had not started. So August, September, October of couple of months, which we had not started offering the domestic fund, but we had already the Mauritius fund. So this is representative of the WhiteOak strategy that the team has managed. We had very strong performance in 17, few months, 18, 19, 20. 21 was more average, 22 was worse, and so was 23. These reds represent relative to the peer group. Peer group here is everyone that is more than 1,500 crores of AUM as of August 31st, 2024. So it also includes some of the recent folks who have, started and have been successful. So there is a survivorship bias. And very importantly, unfortunately, they don't have 2018. Okay, because quite likely some of the folks who've done very well, extraordinarily well in years like 22 or 23, they would have done very poorly in years like 2018 and 19, as this one is a classic example where 18 and 19 was bottom of the pile. But if you look at just 20 onwards, or even worse, 22 onwards, these folks might be towards the top of the peer group because they've only experienced part of the cycle. Yeah, and this graph, if many of you remember, what the red line, for a minute, I'm not going into very many details because I've covered this in the past several times and don't want to be repetitive. But if you look at 2017, where we started, till the end of 2019, the better governed companies or segments of the market were outperforming. Then from 2019 to end of 2021, it was more or less flat, a small decline over an extended period of time. But from 2021 till some point in July, this quarter just gone by, June or July, this thing has been on a tear, meaning poorly governed companies have outperformed very substantially. So much so that this index, which started at 100, went all the way down to 80. And now, over the last few days or couple of months, you'll see that this thing has reversed. Now, we don't know how far this would go because it has had false reversal, interim reversals, not false reversal, interim reversals in the past, only to turn back around. But we tend to do better when better governed companies do well, as we did, in this time period. And now we have done since this thing has turned around. And it is a headwind when poorly governed companies do well. It is a headwind for our performance given the way team invests and what are the important considerations for the team. So at a time like 2017 to say 2019 end, good governance was doing well. Small caps were doing terribly between this time frame, as you can see here. Yeah. Despite having overweight in small caps, because good governance was doing well, we were top of the peer group, as you can see here in 2018, 2019. And hence, during December 2017 to 2019, we were the best performing of the peer group at plus 8.2. Then December 19 to 21, we did very well. We were top quartile or thereabouts. Benchmark was 25%, we were 35% during that time. So very good performance, even when governance was neither a tailwind nor a headwind, as you see over here during this time. Yeah. And it's only during this time when governance, poor governed segments of the market did very well that we suffered during that time. And year to date, we are about average. And these numbers are unfortunately not updated to September because September at end numbers weren't available for competitors. But as they're become available over the next couple of days, my expectation is because of the stronger September we've had, this relative ranking might improve further. So these factors have very far-reaching impact. Yeah. So when this was going up, this was going down, we were top of the peer group. But when this was going down and this was going up, we trailed behind. Not at the bottom. One would argue, we held up reasonably well as there are several, during this time period that have fared much worse, but certainly not as good as, or certainly a lot of room to have done better this time, but these headwinds were extremely strong. And now, if this were to reverse, sooner or later it's going to reverse. That's how markets work. These lines don't continue in perpetuity in one direction. If you look at history over the last 20, 30 years, these lines do move up and down over time with a mean of 100. So whenever these were to reverse, I think the team is very well, the portfolios are very well positioned to perform on a relative basis better than the peer group, and the peer group may suffer. Some of the peer group may suffer the fate of 2018-19 when, and there are lots of PMS and AIFs who started over the last 2, 3 years and have rode the momentum of SMID cap and poor governance. They can unravel in no time. Yeah, as was seen in 18 and 19. So just quickly now, in a minute or so, also wanted to touch upon our emerging markets equity strategy, which many of you have been early investors in since we started in 2022. Over the last 2+ years, this has delivered 18% return compared to 8.87. So 935 basis points US dollar outperformance annualized cumulative basis 46% dollar return compared to 21, 25% outperformance. In rupee terms, that translates into 21 versus 12. So 960 annualized and 26 percentage points overall outperformance. It puts us in the top 2, 3 percentile or even top 1 percentile of the peer group with very consistent outperformance in each calendar year. This is GEMX India, EMX India for those who invest through LRS and don't want to take a chance of investing in a EM fund which also invests in India. We also have a unique offering, which I doubt any of our peers have, which is EMX India. By the way, we are the only asset manager that has in India or from India that has in-house investment capability to invest beyond India, fundamental active investment capability, not a quant model or something, but research analysts present on the ground. As it's not, sorry, the team slide is not here, but there are analysts covering Asia, outside of India, Latin America, Middle East, emerging Europe, and so on and so forth, which have all generated very strong performance across markets. Last quarter was difficult for us, which turned the negative, the 24 quarter in EMX India because of how well China did, as you all know, and I'm sure there'll be questions to that effect. And we were underweight in China, so that did hurt us last quarter. I'm going to stop here. I've exceeded what I had planned for myself, and I'm going to turn it over to Rohit for the next 30 minutes or so to talk about what is more exciting, which is the quick commerce opportunity.